This is the diagram that I had on the board, and I'm using this to explain the relationships of debits and credits between assets, liabilities, equity accounts, as well as revenues and expenses. Those are our 5 usual suspects, if you remember. Let's look at a couple of different scenarios and see how debits and credits are used to keep this equation in balance. In this scenario, we're going to sell $500 of our firm's services for cash. So cash is going to increase, and remember, cash is an asset, and we increase assets with a debit. So we're going to debit cash for $500. Additionally, we have earned a revenue when we sold those services. So we're going to increase revenues with a credit. And look what happens here. We're increasing a credit. And if you remember, revenues are part of the income statement. So revenues, all things being equal, increase net income. And net income is mapped over into the statement of retained earnings as an addition. So all things being equal, net income will increase retained earnings. And retained earnings is a component of equity. So fundamentally what we've done here by crediting revenues is to increase equity. So that's why we credit revenues. Next, let's sell $500 worth of our services on account instead of for cash and see how that affects the equation. Rather than increasing cash, we're increasing the asset accounts receivable by $500 with a debit. Revenues doesn't change. We still increase revenues by $500 with a credit. Suppose the customer pays their account off now. We receive cash from the customer, so we increase the asset cash by $500. And the customer no longer owes us that accounts receivable, so we decrease accounts receivable by $500. And notice we had a wash in assets. We increased assets and decreased assets by $500, so our equation is still in balance. Let's switch gears now and look at expenses. Let's say that the firm receives a $100 utility bill for the month. We would increase utilities expense by $100 with a debit. And this is the tricky part. We're increasing an expense, and an expense, that's a negative, isn't it? So fundamentally, we're increasing a negative number, and by increasing a debit, that decreases equity. Let's think it through. All things being equal, if I increase expenses, I decrease net income. All things being equal on the statement of retained earnings, if I decrease net income, I've decreased ending retained earnings, which again is a component of stockholders' equity. So I've decreased stockholders' equity. Therefore, that debit decreased stockholders' equity. We increased utilities payable by $100. We haven't paid it yet, so we owe it. So that's a liability. And remember, we increase liabilities with a credit. So look what happened here to our equation. On this side, we increased liabilities and we decreased equity. So it's a wash. We increased this side by $100 and then we decreased it by $100, so our equation is in balance. Now we're going to pay that utility bill. What do you suppose happens to cash? We decrease cash by $100 with a credit, so that's an asset. So the asset side just went down by $100. So what has to happen over on this side? Something has to go down here as well, right? Our utilities payable, we no longer owe that. We just paid it. So we're going to reduce utilities payable with a $100 debit. In effect, we have decreased assets by $100, and on the other side of the equation, we've decreased liabilities by $100.